Direct lending and sustainability in alternative asset classes, examining profitability, ESG factors, and risk management. Presentation overview. Direct lending. Direct lending is a profitable investment strategy that involves lending money directly to businesses or individuals, bypassing traditional financial intermediaries. We'll explore its advantages and risks. Sustainability in alternative asset classes. Sustainability is becoming increasingly important in the world of alternative asset classes. We will discuss how ESG factors are driving sustainable investing strategies and the impact of sustainability on investment performance. Direct lending. What makes it so profitable? Overview of direct lending. Direct lending is a form of alternative lending that connects borrowers with investors directly, bypassing traditional banks. It offers higher yields and lower default rates than traditional lending. Lower costs and fees. Direct lending is more cost effective than traditional lending because it eliminates the need for intermediaries like banks and other financial institutions. This leads to lower costs and fees, which in turn increases profitability for investors. Risk management. Direct lending often involves collateralized loans, which is a form of risk management that helps to minimize the risk of default. This leads to lower default rates and increased profitability for investors. Advantages of direct lending. Lower default rates. Direct lending has lower default rates compared to traditional lending due to better risk management and borrower selection. Higher yields. Direct lending generally provides higher yields to investors due to elimination of intermediaries and reduced operating costs. Greater diversification. Direct lending offers greater diversification as investors can invest in multiple loans across different industries and geographies, reducing overall risk. Direct lending versus traditional lending. Direct lending is a type of loan where borrowers are connected with investors directly through an online platform, cutting out the middleman. This results in faster and more flexible loan approvals, lower interest rates, and higher returns for investors. Traditional lending. Traditional lending is a type of loan where borrowers apply through a bank or credit union, which acts as a middleman between the borrower and the lender. This type of lending is generally slow and flexible and comes with higher interest rates. Risks and benefits of direct lending. Direct lending offers many advantages, such as faster and more flexible approval process, lower interest rates, and higher returns for investors. However, it is not without risks, such as lack of regulatory oversight, default risk, and credit risk associated with borrowers. Risks of direct lending. Credit risk. Credit risk is the risk of default by the borrower. It is important to conduct thorough credit analysis and due diligence to assess the creditworthiness of the borrower and minimize the risk of default. Interest rate risk. Interest rate risk refers to the risk of fluctuations in interest rates. Changes in interest rates could affect the value of the investment and the cash flows generated. It's important to have a well-diversified portfolio and employ hedging strategies to mitigate the risk of interest rate fluctuations. Liquidity risk. Liquidity risk refers to the risk of not being able to sell an investment when needed or only being able to sell at a significant discount. It is important to have a diversified portfolio and to invest in assets that are highly liquid to minimize the risk of not being able to sell the investment when needed. Overview of sustainability in alternative asset classes. Importance of sustainability in investment. Sustainability is a key consideration for many investors. Environmental, social, and governance factors have become increasingly important in investment decision making as investors consider the long term impact of their investments on society and the environment. Sustainability in private equity. Private equity investors are increasingly integrating ESG considerations into their investment strategies. They are incorporating sustainable practices into their portfolio companies, which can lead to long term value creation and positive social and environmental impact. Sustainability in real estate. Real estate investors are also recognizing the importance of sustainability. They're incorporating sustainable building practices and energy efficient technologies into their developments, which can lead to reduced costs, increased property value, and ESG factors. Environmental factor. Environmental factors such as climate change, pollution, and resource depletion can impact the long-term sustainability of an investment. Sustainable investing strategies consider the environmental impact of an investment. Social factors. Social factors such as human rights, labor standards, and community development can impact the long-term sustainability of an investment. Sustainable investing strategies consider the social impact of an investment. Governance factors. Governance factors such as executive compensation, board diversity, and corporate transparency can impact the long-term sustainability of an investment. Sustainable investing strategies consider the governance of an investment. Sustainable investing strategies. Different sustainable investing strategies. There are different sustainable investing strategies that investors are using to incorporate sustainability into their investment decisions, including negative screening, positive screening, and impact investing. Negative screening. Negative screening involves avoiding investments in companies that do not meet certain environmental or social criteria, such as those engaged in fossil fuel production or human rights violations. Positive screening. Positive screening involves investing in companies that meet certain environmental or social criteria, such as those engaged in renewable energy or social justice initiatives. Impact investing. Impact investing involves making investments that aim to generate a positive social or environmental impact in addition to financial returns. Examples of sustainability in alternative asset classes. Renewable energy. Renewable energy is a sustainable alternative asset class that includes solar, wind, hydro, and geothermal energy. It offers potential benefits such as lower carbon emissions, energy independence, and cost savings. Sustainable real estate. Sustainable real estate is an alternative asset class that focuses on environmentally friendly buildings and communities. It offers potential benefits such as lower operating costs, improved health and well-being, and reduced environmental impact. Impact investing. Impact investing is an alternative asset class that seeks to generate positive social and environmental impact alongside financial returns. It offers potential benefits such as addressing social and environmental challenges, promoting economic development, and diversification. Conclusion. Direct lending. Direct lending is an important trend in the world of finance that offers investors the potential for attracting risk-adjusted returns and diversified benefits. Sustainability in alternative asset classes. Sustainability is an important factor in alternative asset classes that investors consider when making investment decisions. ESG factors such as climate change, social impact, and good governance are becoming increasingly important. Thank you.